Well, as Basant Maheshwari joins us now, let's take a conversation forward. Let's talk about theme sectors and what is ideas for 2022 are. Basantji, good morning. Thank you for joining us. Wish you and your family a wonderful year and best wishes for 2022.
Good morning, Nikuj. Happy New Year to everybody, including you and the audience watching us. Nice to start with you on a New Year day.
Well, they say that well begun is half done, so we are starting the year with you. And we don't interact with you on television these days, but Basant Maheshwari has a reputation that every time he comes on ET now, he's going to talk about themes, ideas, and stocks. So let's start with that. Like they say, tradition break nahi karna chahiye. What is your big idea for 2022? Do you think this year will be a year of good returns, solid returns, decent returns, or no returns?
This will be a year of moderate returns, Nikuj. I don't think we should be thinking about, of course, there is a liquidity and markets will go up and retail money will come in. But beyond a point, you need extra horsepower to push the bull. So that extra horsepower, I don't know where it's going to come from. So this will be a decent year. It will not be a bad year. It's not going to fall. Nothing's going to collapse. But still, at the same time, there has to be this mental endeavor to protect what you have made over the past 2 years. So I'm not sounding bearish, and like many of my co-fund managers say, cautiously optimistic, nothing like that. I'm a little cautious, but invested.
So your positioning in the portfolios which you manage is that you by and large are fully invested.
Yeah, normally we are always invested because it's very easy to leave the market thinking that it's going to fall. It might fall, but then it won't give you an invitation to rejoin. So people who have exited the market don't get a chance to come back in. So you will have to take the pain with the gain. And if you think that you can sell it right now and buy at lower levels, it hasn't happened to too many people. It'll happen by chance. You do it for a couple of hundred shares, you can do it. But for an entire portfolio, large portfolio, it's not possible.
And I just want to bring this point out for our viewers here, and just Basantji, just making this point for the benefit of our viewers, that maximum gains in the market are made by spending time in the market, not by timing the market. And in a bull market, more money is made when you're waiting for the correction rather than the actual correction occurs. I'm speaking out of experience. You may have a view on the market and wait for the correction. What if the correction does not come in? And when the correction will come in, like we saw in the month of December, the quantum was not even 10%. So that is what typically happens in the bull market. We keep on waiting for the correction, don't spend time in the market, try to time in the market, and the train leaves the station. So Mr. Maheshwari, how exactly is your portfolio different from last year? So let's say 1st of Jan 2021, what was the positioning of your portfolio and what is the positioning of the portfolio now?
So before that, Nikunj, the correction part that you said, it makes a quite a valid reasoning, because what if the market goes up 15% and then falls 10%? So those kind of situations, you would have to understand that the market can go up a lot more and fall back, and the bottom point would be still higher than what you are right now. So in coming back to the portfolio positioning, last year we had a few banks in the portfolio. We exited banks maybe by the Jan-Feb last year. We exited all the financials because what one could see was this financial where the cause of pain to India, because our domestic economy wasn't able to function as it should have been because of COVID and lockdown and other things. And everything that was globally linked has now got the leg up. So IT, pharma, the global metals, the global auto majors, they are doing well. The domestic guys are not doing as well. So that was a big change which we saw last year. So between these two, I think you should be globally positioned, because that is where the money is coming from and that is what is being chased.
Good morning. Happy New Year. So, as you said, it's time to be cautious, but to also stay invested. Don't time the market. So you've just talked about how you exited financials. You've told us about the global play as far as autos go. So when you stay invested, can I ask you what it is that you're buying, what you're seeing merit in? Because you've ruled out financials, which have anyway underperformed for the last 2 years, the worst underperformance since 2006.
Yeah, so what we are buying, Nantara, is I think we're looking at metals. They've had a sideways move. They're not doing anything extraordinary over the past 3-4 months. We are looking at global auto majors, like everybody knows the names. So these are the kind of companies we want to look at, because you don't want to be in a situation where a lockdown or a domestic, see, we won't have a lockdown, everybody knows it, but still the perception is that if people aren't able to work freely, it will be difficult for them to go and return back the loans that they have taken. So there will be a capex coming, there will be a capex cycle, everything would happen. But for the moment, the cloud is on the banking space and the financials. So except for financials, I think other stocks you should be buying and looking at them, because that's what the screen also tells you these days.
Okay, so financials, you continue to have the sell button. You got buy on the global auto stocks as well as the metal pack. You talked a little bit about IT. You referred to lockdown. Now, even if you just look at the IT stocks, the comeback that we saw in December, earlier in the year, we were talking about, are they overstretched? There's exuberance that's coming back for IT. Look at the gangbuster numbers that Accenture reported globally. How would you approach that space? Because, at one end, you do talk about valuations being stretched, but it seems like such a safe bet.
Technically, it's supposed to be safe. We don't have IT, and that's a sore thing for us. See, what happens is when the foreigners sell, the dollar immediately goes up. So IT is an automatic balancer to that. And secondly, IT is not an Indian company. It's an Indian company with US operations. So basically, if US does well, if the NASDAQ does well, if Tesla runs out of inventory, then obviously these guys get more work to do. So that's the theme which is pushing the IT space these days. So I think IT, if you understand the companies, then that's a nice space to be in, because these are the automatic balancers that you look for when your current account goes through the roof and when the dollar hits 76 or 77. So I think these are companies which, if you understand, you should buy them. But if you don't understand and you're buying a 50p company when you don't understand what they're going to do, then if the stock falls, you wouldn't know what to do. So the first thing to do is you have to ask yourself, would I buy more of this stock if it falls 5, 7, 10%? So that's the question you need to ask yourself.
Sure. Basant, though, the market is polarized in quite a strong manner. Do you think in 2022, the big will only get bigger and the small becomes even smaller? Is that a trend that's here to stay?
That's been a theme for the last 2-3 years, if you look at it, because the returns from the large caps haven't been bad at all. Some large caps have gone up 3, 4, 5 times from the bottom of the COVID thing. So, and in the small caps, the thing is that if this market is being driven by foreign money or domestic mutual fund money, not so much by the retail investors, because when the retail investor buys, he looks at the smallest of small caps. When the mutual fund buys, it wants to have the entry and the exit also. And scale, after this GST thing and other things, I think scale is what is benefiting these large and mid caps. And especially at an index level of 17.5 and 18,000, you don't want to be with the smallest of small caps. There's an entry problem, there's an exit problem, and plus these are the first stocks to fall whenever there is an issue. So you have to be with the large caps. That is what we think, actually.
Sure. Basant, the big, disruption seems to be playing out within autos. So with, EVs really getting more and more prominent now on the Indian roads. That said, while the disruption is larger, I would say, in the two-wheeler space, and now it seems that Bajaj Auto is also looking at going the EV way, the competition is pretty stiff from the unlisted lot. Tata Motors, as of over the weekend, it's already become the #2 car maker, or car seller, I should say, in the country. It's overtaken Hyundai as well. They've already, spelled out their EV plans going forward. And then, of course, there are the iShares and M&M, which, because of the rural recovery, have done well all throughout past last year. Where within autos are you finding comfort to buy afresh, if at all?
No, we own Tata Motors, but we are not buying at this price, because we think the price should now wait for earnings to catch up. The semiconductor issue. So people say you have to buy them when the semiconductor issue gets solved. So then you would get the price also, which would discount the semiconductor issue getting solved. So you buy it now at this price thinking that the issue will get solved, and once the issue gets solved, the price would go up. Maruti, I think, has lost the plot. In my words, they were kind of sleeping on the wheel. They have just held themselves back. They waited for Suzuki to do something with Toyota on the EV space. And I think in between, Tata Motors has just taken up the entire race for itself. Bajaj Auto is starting now, but the unlisted Ola and those kind of companies, they have got a head start right now. And today the problem of capital is not there for the unlisted space. 20 years back, if you were a large listed company, you could get capital, but an unlisted company couldn't get capital. Today, the PE funds are more than happy to write a check for the unlisted names. So the problem of not being listed and not able to raise capital is disappeared. But I think in this space, of course, Tata Motors has done well. We own it. It's not a recommendation at all, but it's going, the price, I think, should wait for earnings to catch up now.
Basant, we had 60 IPOs last year, and a lot of attention was still centered around Nykaa, Paytm, Zomato, Policy Bazaar, but those are 5-6 IPOs. What about the remaining 55? Have you identified anything which could be a structural idea, a new business, an interesting business, a great company which hit the market last year and could be in portfolio stock?
Many companies, Nikuj, but you don't buy them at 100 PE for a 20% growth. 20% growth, I can give 50 PE. For a 30% growth, I can't give a 500 PE. Giving a 500 PE to a stock means that if the earnings are constant, it's going to take you 500 years to get back your money back. So 500 years back, I think the Babri Masjid was made. So, these things you cannot buy at 500 PE and hope to do well. So there are two types of IPOs, one which need constant influx of cash. So those kind of companies like a Zomato, no recommendation again, they will have a problem if the market goes down, because where do they get more cash to burn? But there are companies like Nykaa who are self-generating the cash through internal accruals to grow. Those kind of companies will still survive and do well. But I think the present price has eaten up a few years of return henceforth. So if you want to buy them, you buy them, but don't expect any returns for the next couple of years at least.
Last year, while we spoke about internet companies like Nykaa, textiles have made a comeback. But PSU Banks, when banks underperformed, State Bank of India gave a return of 70% plus. Union Bank gave a positive return. So it's like saying that we were in a market where true blue value really made a comeback. Is that one-time re-rating in PSUs, PSU banks, metal stocks, beaten down construction names, is that behind us now?
So when a market goes from a complete bearish phase to a bull phase, the bad companies do well, the bad stocks do well. You wouldn't find a Kotak Bank doing as well as maybe a Bank of Baroda when the market is going from a complete bearish phase to a bullish phase. Because in a bearish phase, you assume all these dud stocks, or the bad stocks as we call them, are all going bankrupt. So they are priced for as a going concern, as you say in accountancy. But beyond this also, there is some value in those kind of companies. You have to look at them. There are companies in the metal space which are going debt-free, assuring you of a consistent 6 to 7% dividend yield for the next so many years. And there are so many macroeconomic variables that have changed. They've not done well for the last couple of months, or maybe 3-4 months, but that doesn't mean that the value has gone off the table. So you would have to look at those kind of companies where you are getting a dividend yield of 6, 7, 8% available below book value, and who are repaying back debt. So I think that's the way to go forward.
Basant, I know when we look at active management and do stock picking, you're not supposed to look at conglomerates and be more stock specific, but it's also been a year where you've seen the HDFC group, for example, really underperform. Reliance Industries, for the first time in 7 years, has trailed both the returns of the Nifty as well as the Sensex. M&M is trying to make the right noises. The Tata Group, on the other hand, has also headed in the opposite direction, which is the way up. So the changes that we're seeing in India's leading conglomerates, how do you approach all of that?
So Tata, from a family-owned business, has become a completely professional entity. So I think the magic is not in the Tata. The magic is Mr. Chandra, who's taken over. He's divided the entire group into different business units, and he wants to scale them up. Reliance, on the other hand, they had this retail thing and they had a telecom thing. So both of them are not quite firing the way they would have liked to. I think the tariff hike in telecom would do something for Reliance, but it's so big. HDFC with a 10 lakh crore deposit and market cap, those kind of companies, it's very difficult to actually look at them and then assume them to be generating the same type of growth that they have done for the last so many years. So leaders normally they change, and from HDFC Bank, I think ICICI Bank has now come and taken over the mantle. So no recommendations again, but then still HDFC Bank will be an HDFC Bank. You can buy an HDFC Bank and go to sleep, but then when the market recovers, the smaller ones do better.
We're also at the crossroads, of an equity bull run, inflation, and we don't know what the RBI is really going to do, but also it's the first time where you're seeing the profit pool being real, the capex cycle that is coming back. Nikunj, for example, talked about textiles. Is a return of manufacturing, PLIs schemes that are being announced by the government across sectors. Wouldn't that be a theme to play, even though you're saying sell off banks, which is considered to be the best way to play on capex?
No, but interest rates are due for a hike. The only hope that we have that interest rates wouldn't be raised by the US Fed. One is this COVID variant, which keeps coming every 1 or 2 months. The Fed cannot assume to raise interest rates when COVID is around the corner. And the other interesting thing is China is cutting rates. So if China is cutting rates, it's like telling the US and the Eurozone, okay, guys, you raise rates and let's see what happens to the currency. Because if China cuts rates, the yuan depreciates. And if the yuan depreciates, Chinese exports become more competitive and Chinese imports become costlier. So these are things that the globe will have to sit back and take, because we discuss the US and the Fed 80% of the time, and for the balance 20%, we talk about the Eurozone and China. But China is again at $14 trillion economy. So interest rates, whether they will really go up or they don't go up, we don't know. But when banks and financials couldn't perform in such a low interest rate environment, assuming that they would perform when interest rates are going up would take a lot of hard work from these people.
Okay, Basant, great to have you on the show, and here's wishing you and your family as well as your entire team a very happy and prosperous and healthy new year from all of us once again.
Thank you, everyone. Thank you.